is Steve Lentz. I'm with Discover Options, and welcome to this presentation of Bollinger Bands Part 2. It's December 10th. Printed material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Well, welcome everyone. This is kind of a follow-up to what we talked about here, I want to say about 3-4 weeks ago or so on a Monday afternoon here in the Chicago area, so we're Central Time Zone. And if you take options, it's kind of natural to gravitate towards indicators that are volatility-based. Okay. And so what we did is last time we kind of did an introduction to Bollinger Bands, and this time I'm going to review that introduction and then go in more in depth and actually present to you an option trading system that you could use with Bollinger Bands. All right. Without further ado, here we just review. These are some of the same slides. I'm not going to take so much time, but we're just kind of going into it here. Bollinger Bands, what are they? I like to call them deviation bands. I'll just make a general observation. Bollinger developed these things back in the early 1980s or so, and they kind of took the name Bollinger Bands, but really what they are deviation bands. Now, he has since, I think in 2007, he trademarked them. Trademarked the name, and he's expanded on them, and he has other indicators based upon these things. But if you want to know what they are, we could also just label them deviation bands that were really invented by John Bollinger. Okay. And what are these? These are volatility bands placed above and below a single moving average. So you have a single moving average placed with the price on a chart, and they have a band above and a band below this moving average. Now, the volatility is based upon the standard deviation that changes as volatility increases and it decreases. And I'm going to show you that in just a second, make it very clear. These bands will automatically widen when volatility increases. So let me just show a little bit. Here is OptionVue's settings screen that you would see with OptionVue's price charts. And typically, default charting program is going to have a similar type setup, basically where you have a Bollinger Bands that you'll be able to determine the periods of the average and how volatility is determined, and also where the bands are set, either one standard deviation, or you can take 2 times that one standard deviation, and that's important that you understand what we are not saying here. The band is always the moving average. The band is going to be either a 1 standard deviation band, or if you say 2, you're really saying times 2. So you're taking 1 standard deviation times 2. Go in there. What's the trend line? Says TJ. We're not talking about the auto trend line. That's an algorithm. Use some regression studies that Len Yates came up with, and that's part of OptionVue's price chart. It's kind of cool. And so that's a whole nother to talk about, TJ, but maybe be another presentation. All right, so let's just kind of go into this a little bit. Here you have a typical chart, and let me grab a little pencil. Because on my laptop doing this gets kind of tricky. So put the phone to my ear, and then we kind of start out here. And let's say you have a moving average coming like this. Something like that, all right? Now, we're talking about deviations. We're talking about how far the close varies from the moving average. You see? And so what you have to do is basically look at how far each data point the moving average. And of course, way back here, on the part of the screen, you have some pretty strong deviations from the moving average here. Now, as we get over to the right, you get that these distances are much lower. So deviations on the right side are far less than the deviations on the left. And if we were to draw volatility bands around this moving average, what you find is that on the left, it'll be kind of far away from the moving average, and as you move to the right, the bands will get much closer because the deviations are so much less. Click the button, and there you go. That is, and I'm doing this in Metastock because I'm going to post 2 Bollinger Band sets on one screen, and I needed to go to Metastock to do that. But sure enough, here on the left, look at this. The band kind of far away. Move to the right, you see how the bands are now coming down closer together, getting very narrow, much closer to where the moving average is, and that's because these deviations are getting less and less as it goes on. Now, the actual algorithm is, we can kind of, sell up and show you the math, but I wanted to just express the actual concept to kind of understand. Now, what we're showing you here are 2 standard deviations. That's where the bands are. We kind of finish the last slide right around here. Now, look, watch this then. As the deviations begin to increase again, they're getting wider and wider away from the moving average. Sure enough, the bands begin to widen out again. See, and then as price comes now closer to the moving average right here, look at this. Now the bands are coming in again. That's what the bands are kind of representing when you look at Bollinger Bands on a price chart. Now, how do you trade these things? What signals can be generated by Bollinger Bands? A number of things. There's 2 things I'll talk about here briefly today, and then we'll get into the credit spread approach using Bollinger Band trend breakouts. First, you could trade these things using Bollinger Band bounces. Bollinger Band bounce. It's when price touches or in particular closes beyond one of the volatility bands or the deviation bands, and then reverses and closes inside. And quite often when it does this, the second time can be the charm. All right. Also, and this is kind of John Bollinger came out with, was his the Bollinger Band width can be very important in determining which of these signals you want to take. All right, example, here you have the bands are fairly narrow and we have a close outside the band, close inside the band. Now, Bollinger Band bounce by, well, given that it all happened when these were kind of narrow and expanding, probably not. However, come out and look at this one here. It closes, above the Bollinger Band. This is underneath. That's a more reliable Bollinger Band bounce signal, because usually, and why? It's because, well, the bands were quite wide at the time. After that, quite often you'll see price then back to the mean after that happens. Now, second time's a charm, and actually this guy named Arthur Merrill back in the 60s and 70s wrote quite a bit about M and W patterns. And you can go on John Bollinger's website, and he kind of, really likes Arthur Merrill because of the M and W pattern philosophy, and Bollinger Bands can help confirm the kind of M's, like this would be an M top, kind of ended outward a little bit, and then the W's would be the other way, noting the bottoms, like here. That, okay, kind of a W pattern in where you market bottom. So that's the Bollinger bounce. Now, we could devise a whole credit spread approach based upon that, and I am working on that, and we'll read out shortly. But today I want to talk about the Bollinger breakout approach, and I'm just throwing it out there because look, what we teach in our mentoring program is that we want to have our capital being used judiciously in a smart way where we're managing the risk, but we are rotating our capital into good opportunities. And when one trade closes down and it freezes up, it then unfreezes that capital, it loosens it up and allows that capital to be redeployed, we need to have a good continuous flow of ideas that make sense. Right? I mean, if you're in a good credit spread and you've made 80% of your yield, you could close it down, free up that capital for something else that comes along. And so, one of the things you could monitor Bollinger Band breakouts. And so how it works. Instead of looking at the 2 standard deviation Bollinger Band, we're instead look at the 1 standard deviation Bollinger Band. So it would be a 20 moving average with 1 standard deviation band. And I'm showing it here in green, if you can see that. We're in green. So let's way on the left. And here's how it works. Price touches or beyond the upper line or the lower line, and that signals a trend. So we're looking for it to close outside the 1 standard deviation line. When on the left, we have a point right here. Now let's just say that previous to this, it was in a downtrend, and this is the first time closed above the upper deviation band there. Okay. Now, when is the next time that it closes underneath the lower band? Right? Well, let's look. Price kind of goes up, chugs along. We hear, and you know what? It does not close underneath that lower band, that lower green band. It comes close, but no star. It closes underneath the lower 1 standard deviation band. We're in an uptrend. So technically, we're in an uptrend here. The time it closes underneath that lower band is right there. I'm calculating that right there. At that point, the trend now is going down. We are now in a bear trend until it closes above the upper band. Now, if it comes close, nor though, the trend is still technically down, and it continues on down. And this is how we're saying that trend is determined. You know, when price breaks out and closes outside that 1 SD band, you know, that's a good sign that maybe the trend is now changed and flopped over. You know, it breaks out and outside of that band for the first time since closing in the other direction, is what I'm saying. And that happened over here. The first time it closed underneath the lower band since over here on the left. I'm talking about closing. And the price is not a intraday movement, not just touching the band. It has to close outside that 1 standard deviation band. Absolutely. How we're defining trend. The trend is either up or down. Okay, there's no in between under this methodology. Look at a Bollinger Band chart. You're not going to. I've ruled you forever, right? Now, when you put it on a 20 and a 1, if you could go to a 1 standard deviation Bollinger Band, now you'll be able to look at the chart and tell whether the trend is up or down. Much like a point and figure chart, at a glance, way is the trend. Okay, you should be able to put a 20-1 SD Bollinger Band and immediately tell if the trend is up or down. Real simple. Okay, now, where do we go from here? What's my next chart? Here is the credit spread system premise. A simple set of rules. You can take these rules and refine them and put yield grab analysis behind them, all you want, but it's just kind of a good baseline set of rules. I'm going to show you some back testing work we did, and just show you that it appears to have a nice edge here, at least in the Russell here over the last year. Okay, here it goes. When price closes outside of that 1 SD band for the first time, that's since it closed the other way, all right, it signals an actionable trend breakout. I'm throwing breakout there, all right? A credit spread with the short strike just outside the opposite 2 standard deviation band, to make money by the time an opposite trend is established, all right? I know it's mouthful, but here, let me just show you here. Okay, so let's take the leftmost signal that we did before, right here. You see that? All right, what we're saying is that is an actionable trend change. If the trend was down prior, that it popped up, closed outside the 1 SD band, we're saying, aha, the actionable trend break in the way. Now, if we now put on an option trade, and what we're going to do is go down and look where this 2 standard deviation line is. What we're going to do, and let's say, oh, that's at maybe, I don't know, 1310 or whatever, 1320. We're going to sell premium right there. And the notion is by the time the market reverses course and closes underneath this, the trade will have made money. So we're going to sell that premium, go farther out and buy premium in a credit spread. Time decay and trend work in our favor. Okay. Let me see. I hope, Jim, can you see the Jim, if you can see the private message here. Deb's having trouble with sound. If you can just have her go to communicate an audio broadcast, I have to log in again. Okay? Just maybe send her a private chat. Going to communicate and then join an audio broadcast. What we're saying is that we're going to go out of the money and sell that premium, and time will be in our favor and trend will be in our favor, so that by the time it reverses, well, they go ahead and go the other way then and take that one off. So technical rules, and then what we're going to do is I'm going to walk you through the year of these signals in the Russell, and then dive into one of the trades in greater detail. On bullish credit spreads, I'll just show you these rules, and at the end I'm saying here, bearish, you know what, we're just going to invert those. Real simple. Bullish credit spreads. Here's the setup. Okay, they were in a downtrend. It closed below the lower 1 SD band. We're waiting for it. What we're doing is we're waiting for it to close above the upper SD band for the first time. And that's what the sentence is expressing. Since it closed below the lower 1 SD band, price now, ta-da, closed for the first time above an upper 1 SD band. Dash 1 is the setting, whatever charting program you're using. Okay, so it's been down, trend has been down. Now, today, all of a sudden, it closes above that 1 SD band now at the close or near the close. And you can do it at the open the next day, certainly. For the testing purposes, I did it at the close, but you certainly can do it at the open the next day. All right. At that point, we're in a credit spread. Now, here's what we do is at the close, that's how we tested this, enter out of the money credit spread position, and this with the short strike position just outside the opposite 2 standard deviation band. So I showed you. Okay, once again, signal here, we go to the opposite down here. And we're going out of the money put. Do a put spread. Okay, did I put puts here? I didn't put the puts. All right. Short strike, out of the money credit spread. Time out here. Let me just type in put, out of the money put credit spread. Sorry about that. Out of the money put credit spread. We're going to go to the first month with over 21 days to do this. We want to make sure we get at least 5% yield. Down in the puts, I'm doing it in the puts, and so there's usually higher implied volatility down there. However, it is an upside breakout, and vol usually drops on those upside breakouts. So, but make sure we get 5%. If not, just ditch the trade because it's not enough yield for the risk you're taking. Okay. Okay. Now, exiting. How do we get out of this? 2 ways. One, well, the second one. If the thing just stays in an uptrend forever, just let the position expire worthless. Okay, it goes on to the expiration and it still hasn't reversed course. We'll let it go and expire worthless. Now, I'm going to put a little thing in brackets because talking to some sophisticated folks I know, look, you can go ahead and apply your own yield grab. Why yield grab? You know what? If you've made 80% of your yield on that credit spread and there's still 2 weeks to go, well, you know what? Take it off. Just close it, free up that capital, put it somewhere else where you can employ that capital smartly. Okay, so but in terms of a baseline testing, we're going to go ahead and let it expire worthless. Now, here's the deal. What price reverses, closes on that opposite side USD line, signaling a trend on the bear side, a bearish trend. You know what? When it signals an opposite signal, go ahead and exit it. Exit at the close. Price closes below the lower 1SD band. Look, we're going to reverse our position, right? We're going to close this one, open up a bear call spread at that time. You can kind of see if price keeps flopping around like that, well, we can get whipsawed, but eventually we're going to catch the trend where we get most all of, we'll catch it, we get the full there. So set of rules, and it's pretty straightforward. So let me walk you through the last, I'm back to, I'm on this slide, I'm actually, actually we did not have a signal back in January, February. We had to wait all the way until right at the end of February or so, or the beginning of March, to put it there. Really, because the prices were in an uptrend all going into January, February of this year. And right there where you can kind of see price closed underneath the lower band right there, we would have sold premium right above that band there. We would have done a bear call spread. What happened? How long did it take before prices closed above right here? Right up there. You see that? We jumped in right here and sold premium there, and then prices reversed the other way. And right off the bat, that would have resulted in about a 20% loss on capital. I had about 2 weeks go by, but boy, prices came roaring back pretty fast and stung with a bit of a loss there. Now what happens? On that reversal, we would come all the way down. Now let me just walk you through. We've come down here and sold premium right here until this is reversed course and closed underneath right there. And what I want to do is walk you through how in the world that trade made money. We trade actually made almost 6% yield on capital on that particular trade. So let's go back to March 13th right there when we closed out the original trade that lost money, and then we opened up this new position. So let me go to option view. Back trader, option view, I can go back in time here. Here's the specific time of the chart. Right there, there's March 13th. Okay. You can kind of see we got in on this thing right here, and we sold premium right about there. But price came roaring back and closed here, kind of close to our strike here. Lost our 20%. Now, when price closed here, we look down to the lower band and go, aha, 72. I'm going to sell the next strike underneath that 790 put. I sell the 790 put, maybe the 780, create that credit spread. And what I'm saying is I think that credit spread is going to make money before it closes underneath the lower band. And sure enough, over here on April 5th, it closed underneath that lower band, and we would have bailed on that. We would have exited that trade and opened up a bear call spread over there. Let's go back to March 13th, using back trade and option view. For those of you new to option view, it's kind of like a time machine in option view. You can go back in time, any 30-minute increment during the day, all the way back to January of 2001, stocks, futures, everything that trades options. We've historical data on all option prices and go back and basically shock test any system you have and walk your system through some tougher times in history since January of 2001. You can walk it through 9/11. You can walk it through the summer of 2002. You can walk it through the 08. You can walk it through. Watch this. You can walk it through some of the flash crash in May of 2011. That's interesting stuff, okay? So, I did catch some of that data right there. Anyway, here we are. We're going to the first month with 21 days. April had 38 days. Okay, so we go to the 790. And then we're going to buy the 780, and we put that credit spread on. View, here's what the graphic analysis screen looks like. We're pushing 25% at expiration if it works out. It didn't work out. The market did kind of, go along a little bit, and then it came down, chugged along a little bit for about 2.5 weeks. And what happened? Let's go back and look at the chart. Market. Okay, we put on a bull put spread. We want the market to go up. So it's up, down, then it eventually closes here. Now, we sold premium down here. Now, did enough time, because this is closing closer to us than when we began over here, right? We lost a little bit on direction, but look how much time goes by. A month, and right around a week and a half before expiration. Okay, we're here, okay, a little bit on direction, but then a lot of time goes by, so we begin marching up the screen here. We end up right there. So, once again, we started here, a little over 830. We started right here. We lost a little bit on direction, but we gained in time. And that's why we made, 5, 6, 7% on that trade. Not too bad for a market that just chugged along and didn't race up to the upside. It was on our side, and that's why that trade made some money there. I was asking about the slide presentation. Joe, I think this is going to be posted in an archived recording, and I think Jay have sent out a little link to get the recording on it, unfortunately. So you might have to do a print screen on your computer there and print it out using what do they call it, Paint or whatever. You can just print screenshot and then print it out. The screenshot and then print it out. That would be the best way to capture some of those pertinent slides. This is being posted anywhere on our site that it'll have a PDF, if I'm not mistaken. But you certainly have the access to the recording. Okay, so let's walk through each of the next several trades that occurred during the course of this year. Okay, so we just did that 5.8% gain. We reverse course right there. So then we come up there and sell premium above the red line. What happened then? Price reverse course right here, and we would exit that. Now, much time went by. We lost a little bit on direction. But it took about 3 weeks, though, in time. So they ended up making about 8.5%. Not too bad. Then, what happened? Then we put on a bull put spread. Down the blue arrow is. Price reverse course per bad there within about a week and a half. Yeah, that one ended up losing about 25%. And you go, gosh, where's the edge here? We've had 2 trades lose, 2 trades win. The loser's bigger than the winners. That's no good. Well, watch what keeps going on here, okay? This is why you have to test it yourself and kind of realize what happened. And you can get a feel for this. Look, just know what can happen. You can have 4 trades, 2 of which will lose money there. You look at the character of the market. You look at the character of the over Russell options. Okay, you now see where you can go now. We sell a bull put a bear call spread here. That ends up expiring worthless before we can have a reversal. Here's a reversal signal right here. It closes above the upper band. We'll have a bull put spread there. That ends up expiring for a nice gain. Okay, now where is the next time we have a bearish signal? Right there. This is underneath right here. Then it reverses course right there. So we would expect a losing trade. What did we lose there? You know what? because the way the vol shifted, we only lost 1%. We lost a bit on direction here. Okay, we lost on direction. We come in time, but this also with this big blast up to the upside right here, implied volatility came down a lot. Whenever you sell premium, you gain when implied volatility plummets like that. So that's why that trade only lost 1%, not too bad. Then we're in a bull put spread, selling premium here, expires worthless for a nice gain. This time it reverses is way over here. That one you can kind of tell would have expired worthless. And I think about a week and a half ago, we had a bullish sign go off, and that trade would still be going on right now. But in terms of the closed positions for 2012, this is what you're looking at. Here's a complete list. I threw this little 461 right there, but you can kind of get a feel for certainly this profitable working this year. And I think, if you're looking for a continuous supply trend breakouts that you could sell premium, well, Bollinger Band breakouts, at least in an overvalued market, chronically overvalued market like the Russell options, and it would work well with the SPX as well. Those options are also chronically overvalued, meaning that the implied volatility typically is higher than statistical on a long-term average basis. In those index markets, the options implied volatility on average over a sheer period of time, the option time premium implies volatility that actually comes to pass in the underlying market. Okay, so that is and here I equivocated it to yield right here. There's sinners. I would say, I think the winners probably have, because of these other two here. I mean, and I know this is a small sample. I want to just crank up quick and show you guys that, it's a good premise. You're putting trend in your favor, you're putting time decay in your favor, and in the long run, when you do that, you're having a good edge. All right. Any questions here? While you're typing your questions, if anyone has one. TJ asked, I thought you used 1.25. No, TJ, you might be looking at a presentation I did regarding the CCI. Okay, and the CCI Commodity Channel, is that what it is? Commodity Channel Index, is equivocated to a 1.25 deviation there. Okay, I'm suspecting that's where you're picking that up from, but not in this methodology. We're just doing a standard deviation Bollinger Band. How may DTE to expiration? How many days expiration do you use to position the trade? The first one with over 21 days. So when you get a signal, let me go up. When you get a signal, you go to Matrix and you go, okay, which is the first month that has over 21 calendar days until expiration? In March only had 3 days left. April 38, May 66. So that's why we used the April month, is because it was the first month with over 21 days. Richard, which moving average line do you use? Richard, we are using the 20-day moving average and a 1 standard deviation band to sell the trend change. And we're using the opposite side's standard deviation band to determine where the strike is placed. Where it's placed. Okay? All right, Phil, let me read here. Okay, because all the spread when the underlying is trending away, already a ways away from your sold strike, Do you find that you don't collect enough premium and end up taking mark-to-market pain if the underlying suddenly reverses? Okay, so Phil is saying, he's saying, look, let's go 313. Let's go 13. We're in here after it's already gone up. Saying, do you find that you can take some serious pain if it reverses? Yeah, you know what? If it reverses, come down immediately and close underneath that other line there, and you get a loss. Yeah, that's a loss. That's pain. I showed you here in the last, let's see, 2, 6, 7. In the 8 trades that occurred this year, 2 of them were losses over 20%. Now, we had some 20% gainers there, but sure, that's a loss. Absolutely, that's a loss. What I'm saying, though, is that, look, if it closes above that 1 standard deviation line, okay, remember, as we are speculators, right? We are speculating. That is signaling a trend change from the downside to the upside, and the trend will continue. And it doesn't continue huge. It's going to take some time to close beneath this lower 1SD band and signal a trend change, during which time our position will make money. That's what happened here. You know, it didn't blast off to the upside. It kind of chugged down and got volatile, and eventually 2-3 weeks later, it underneath that lower band, but we still made money on the trade. Okay, I mean, it's a good point, but you're right. I mean, you are getting, you know, in some time frames and in some indicators, this still on 313, you're using a nice stochastic, it would have shown you an overbought signal. Your indicator would show that you're getting in on an overbought position. And what we're saying is no, we're speculating that is signaling a longer-term trend change, and we have an edge. Okay, let's see. Could you use the method to day trade options intraday? TJ, day trading options intraday? You know, options can be very expensive to trade, TJ, especially if you get into specific equities. You know, Apple, Google, I mean, those are fairly liquid options. I guess you could probably try and day trade those. Many equities, though, I mean, you have a spread between the bid and ask that makes it kind of difficult to day trade options. And that really, to be honest, I want to represent something we're not. That is not our wheelhouse, okay? We are much more into longer-term premium selling, grinding out single-digit returns every month. Now we teach in our mentoring class is a holistic view of the potential yields that you can get every month by selling premium. In 3, we teach non-directional approaches. In level 2, we teach some of these directional things. If you're at all in the market for options education at all, please go to our website, check it out, specifically us, and we'll tell you point blank if what we have is a match for what you're looking for. And some folks call and say, hey, I'm looking for this, and say, you know what, it's not our wheelhouse. Where we're at is in the neutral premium selling or the directional stuff. Use smart option spreads to get, you know, good returns here. On the directional stuff, you hit a few of these and you're going to get more than just single-digit returns, certainly. Okay, let me see here. From Adam. Adam, let me read the question and see if Jim Grimm wants to weigh in. I think you saw that, right? If you want to weigh in, Jim, go ahead, and because he wrote that to us panelists, and you could see a question regarding our parts and everything. Joe, how can we get the slide presentation? Joe, I think you're being given a link to the recording, and I think the slide presentation will be available in the venue in which we have our a website set up. We'll have it available in the context of a recording. But you know what? While you're watching the recording, okay, you use your, let me see the screen. We get to the rules part. your print screen button. And you hold your control button down and hit print screen, and it gets logged into your clipboard that you can then paste into a Word doc and print it out. I've done. That's kind of a nice, easy way to cheat a little bit. But again, print screen, paste into a Word doc, all right, and print. That's the best way to get it. So, okay, let's see here. Leon, how do you set up one? Okay, Leon, how do you set up one standard deviation? So let me go back. If you're using OptionVue's Bollinger Bands, in the price chart, you click on the settings button, and you simply go over here, change this one standard deviation number to a 1. Real simple. Okay, now you're using a 20-period moving average, and you're going to use a 1 standard deviation band. It'll generate then for you is the equivalent of this green band here. Again, in OptionVue, we don't have the ability to see both, so you have to kind of go back and go, okay, I got my signal. Then come back here and flip-flop it to 2. Get your you'll go back to 2 to get your strike setting. I am using a 20-day simple moving average always for the Bollinger Band. Yep. Pronounce the part. Yeah, Frank, I think the printouts. I'm going to do this. I'll tell you what. I am going to PDF this PowerPoint. If you email us, okay, you can email us. Just give me your full name and your email. And we will reply, and I will include the PDF for you. Here's where you email. Now, let me see here. Where did you email? Can we info, Jim? Use our info, or what? You want to use mine? info@discoveroptions.com, or, and let me just type this in. Steve, this for you, okay? Just, go Steve@OptionVue.com. Okay. Full name, simple, dot, and on the subject line, equals button, sign equals BB. We don't call it Bollinger Bands. B slides. How about that? Okay. You need to write that down. I'm going to give you the thing right here. Ready, set, go. Click. In the chat view, Morris, I just typed it in. Guys, on the right side of your screen, you should see a chat area. And I just said all attendees. So I'm going to send you the PDF. Sees it. SteveOptionVue.com. Full name. I need in the body of your email, put full name. Subject line, put BB slides. I'm going to hit reply. I'm going to send you the PDF of what I'm showing you here today, and you'll have it. Okie dokie. Adam, after finishing the mentoring program, how do you get access to the feature showing company earnings and deviations to do the spreads? Good question, Adam. Folks, if you're a mentoring student, we give you the ability to access our stock analysis report. For mentoring students only, that includes the earnings that I've talked about before in terms of calendar earnings. You can see every stock's earnings history and how much it moved on earnings. For all mentoring students, that is in the mentoring classroom, and it's labeled Stock Analysis Report. It's cool, and that's a free tool to all of our OptionVue mentoring students. How can I get OptionVue? Real simple. You can go on our website and download a trial for free. It could cost up then and get a walkthrough of the system. But OptionVue.com, OptionVue.com, sign up for a free trial. Okay, walk through and click all the, it's best if you kind of communicate with us in the office so that you can kind of know exactly what you're getting in terms of data, back trader, and all that stuff. Now, when you get OptionVue and give it a try for your 2-week trial, this is important. Make sure you watch the tutorial videos that I did that walk you through the whole program. I take you, basically hold your hand through the whole thing. It takes about 2 hours, depending on how you want to go. It'll take you through the whole thing, and you'll use the whole program really in just a 2-hour time period. Leon asking about the costs. Leon, we have a number of pricing packages depending on what you want. Okay, where from a lease up to a purchase where you can save a lot of money by purchasing it. And please, when you get the trial, look at the video, call us up, and the folks, our consultants, will walk you through all of it, particularly in making sure you're using it in a way that kind of conforms with what you need to have it be for in your trading. Okay, please do that, because that's what our consultants are. That's what their job is, and they're very, very, very good at it, is hearing what you have to say. They're good at hearing how you trade options, and then you know what? Forget this feature. Go over to this feature and use this one. This is where you'll really get a lot of help. Okay? Adam is asking about the stock analysis report available after the mentoring program. You know what, Adam? You get access to that for a year. As part of the mentoring program, you get access, and then we have continuing education that would give you access to that stock analysis report after the mentoring program. So, Adam, check into the continuing education program we have that enable you to continue having access to that tool, as well as all of the inside wires that we have, the presentations I do for the mentoring students. I was asking, are there any other entities than just Russell that are considered good for this strategy? Yeah, Rob, you know what? Any index, equity index options would be good, because those chronically overvalued markets are, in fact, folks, any market that is typically chronically overvalued, we consider good. And we teach this in our program, but in a nutshell, it goes like this. If you go to a volatility chart where you can see the implied and the statistical graphed together, you have access to the average values of implied and average values of historical or statistical, so you can see if the average implied has been higher than the average statistical. Not if they're separated right now, but on average. Average. And when you find a market, on average, implied is higher than statistical or historical, this is a chronically overvalued market, and typically the equity index cash options are going to be like that. Absolutely. Time out. There we go. Perfect. Great questions. We will be back 3 weeks from now, 4 weeks from now. We got the holidays coming up. Okay, next Monday we'll have one of our mentors presenting again. Watch your email, folks. Thanks so much for joining me today for this presentation of Bollinger Bands. Happy holidays, Merry Christmas, Happy New Year, Happy Hanukkah, whatever you celebrate. I hope it's a very, very safe time for you and your family. Take care. Bye-bye.